Welcome back, everyone. Today, we're jumping right into our explainer on Americold's Q1 2025 financials and their overall strategic trajectory. Now, Americold is a truly fascinating real estate investment trust, or REIT, because they don't just own warehouses. They actually operate the mission-critical, temperature-controlled infrastructure that literally keeps the entire global food supply chain moving. In a business where temperature, time, and trust literally make or break the product, well, let's just say the numbers tell a really compelling story. To get to the real story behind their capital allocation, we're going to hit 5 key areas today: the Q1 headline numbers, the economic moat, the EQT joint venture catalyst, margin expansion and efficiencies, and finally, the forward-looking pipeline. Let's get right into it. All right, Section 1, the Q1 headline numbers. Let's dive straight into the core profitability metrics that are really driving the narrative this quarter. We're going to anchor our analysis right here with Q1 2025's Adjusted Funds from Operations, or AFFO. Americold delivered an AFFO of 29 cents per share. Now, if you follow REITs, you know this is the metric that matters most. That 29 cents actually beat analyst consensus and tracked right in line with, if not a little bit above, management's original guidance. So right out of the gate, that's a very strong signal of execution.
But to really appreciate that 29 cents, we got to look at the broader context. If we contrast this Q1 2025 performance with the net loss of $16.5 million from the exact same quarter last year, wow, today's picture is vastly different. We're seeing flat but fundamentally stabilizing physical occupancy levels. That wild inventory whiplash we saw from post-pandemic supply chain normalization, well, that's fading, which proves their operational baseline is finally steadying out.
Moving right along to Section 2, the Americold economic moat. Let's look at the incredible structural advantages they hold in this temperature-controlled logistics space, and how they uniquely protect their revenue.
Breaking down their warehouse revenue mix, you'll immediately notice a heavy defensive tilt. 48% of their revenue comes straight from retail and quick service restaurants, or QSRs. Think about it for a second. No matter what the broader economy is doing, people still need to buy groceries, right? They still need to eat. So this massive concentration in retail and QSR effectively shields Americold from a lot of that unpredictable macroeconomic volatility.
And this moat, it's heavily fortified by deeply entrenched relationships with blue-chip legacy partners. I mean, we're talking about the absolute titans of the food industry, like Walmart and Tyson. These aren't just standard transactional clients. These are highly integrated supply chain partnerships. Because food safety is so critical and the cost of switching providers is just insanely high, Americold boasts a remarkably low 2.5% customer churn rate. Honestly, that kind of retention is almost unheard of in standard logistics.
So why does all this matter? Well, the crucial takeaway here is that 59% of their total rent and storage revenue is locked into fixed, committed contracts. In a business that requires massive capital to build and maintain all that freezing infrastructure, having almost 60% of your revenue locked in gives you incredible cash flow visibility. It means management can actually plan, invest, and deleverage with extremely high confidence.
Which brings us to Section 3, Catalyst, the EQT joint venture. Guys, this is where the financial engineering really starts to shine.
So management recently unveiled a massive joint venture with EQT Partners. Americold is actually contributing 12 existing assets to this new JV at a blended cap rate of 7%. Now, in real estate, locking in a low cap rate like that means they're cashing out at a solid premium valuation compared to where the public markets currently value them. It is honestly a brilliant move. They unlock $1.1 billion in proceeds, yet they retain a 30% stake in the net operating income, and they keep operating the assets. That earns them another $15 to $20 million in annual management fees. Basically, they cash out at a premium without giving up their strategic footprint.
And what exactly are they doing with that $1.1 billion windfall? Well, this transaction directly fuels their deleveraging strategy. By using those proceeds to pay down near-term debt maturities, they are dropping their net debt-to-EBITDA ratio by approximately 0.75x. This drastically accelerates their path toward their stated 6.0x leverage target, which fundamentally de-risks their entire balance sheet.
Next up is Section 4, Margin Expansion and Efficiencies. Beyond all the high-level financial engineering we just talked about, we really need to analyze how they are aggressively protecting and expanding margins down at the operational level, right there on the warehouse floor. Now, the reality of the quarter was that warehouse net operating income actually took a 4.5% hit. That was mostly due to competitive pricing pressures and a pretty tough $2 million energy headwind. But here's the thing, management actually saw this coming.
They effectively neutralized this decline by fully realizing $30 million in annual overhead and indirect labor savings right here in Q1. They had to make some really tough calls, like cutting over 400 positions and completing 2 out of 9 targeted facility exits, but it optimized their overall portfolio footprint.
And crucially, they're achieving these massive operational efficiencies without sacrificing safety or service quality. In fact, their safety metrics are industry-leading right now. When you compare them to recent industry averages, Americold boasts a 44% lower total recordable incident rate. Think about that. When you can take $30 million in costs out of the business while actually outperforming the industry on safety and maintaining that super low 2.5% churn rate, that is absolute operational mastery.
And this also brilliantly illustrates how they view sustainability. With power costs making up roughly 6% of their total warehouse expenses, running massive industrial freezers is, as you'd expect, highly energy intensive. So, their stated sustainability goal to generate 150,000 megawatt-hours of renewable energy annually by 2030, that isn't just some feel-good ESG metric. It acts as a direct, long-term margin protection strategy against any future energy cost volatility.
Finally, we have Section 5, the forward-looking pipeline. We've seen how they protect their baseline, but how exactly are they growing Americold's development and international footprint?
Well, their multi-channel growth is accelerating perfectly across 3 main drivers. First, e-commerce is growing at a double-digit rate, and they just onboarded 3 new accounts to provide 2-day shipping to 99.5% of the U.S. population. Huge, right? Second, internationally, they secured massive sequential occupancy gains of over 800 basis points. That's an 8% jump over in Europe. And third, on the development front, they just announced a highly lucrative 20-year dedicated build-to-suit project for McCain Foods that's going to add 56,000 pallet positions to their network.
All of this incredibly disciplined execution has earned them a very stable Ba3 credit rating from Moody's. The rating agency specifically cited their improving organic EBITDA and their clear debt reduction path. And this is all underpinned by a massive liquidity cushion. We're talking nearly $800 million available on their revolving credit facilities to fund these precise, pre-leased future development pipelines on a completely leverage-neutral basis.
To conclude our explainer today, we want to leave you with this thought to consider. As Americold's balance sheet rapidly strengthens and that $1.1 billion in strategic JV capital is deployed to deleverage, are we looking at a REIT that is perfectly positioned for the next phase of global logistics dominance? I mean, they've optimized the core, they've secured the cash flows, and now they are actively building the future. Thanks so much for learning with us today, and we will see you in the next explainer.